Welcome to the simplest retracement breakdown video you are ever going to watch. This is the one video. If you're looking at a retracement on the 1 hour or anything and you're like, oh my God, how do I know if that's a retracement or not? This video is going to answer all your questions and it's going to help you identify um, retracements very easily. If you haven't been tuning into this series, I highly recommend you do because why the fuck wouldn't you? Here we go. Let's get into this. This is going to basically explain how you can use fair value gaps, equilibrium, and break-a structure on lower time frames to identify reversals. Some people are like, oh, well, you have this thing and then it's 78.6%. Bullshit. Probably works. I don't do it. I'm that smart. Come on now. So this is the simplest way. Let's first identify what is a retracement. A retracement is this. See that pullback? In an uptrend, that lower high, lower high, lower high. That's a retracement. Downtrend, higher low, higher low, higher low, higher low. That is what it is. It's this retracement. What are we looking for this? And why are we looking for retracements? Because price does not just do this. Price does not just go up forever. If it went up forever, would have just bought NASDAQ yesterday and I'd be up today. But this is not today. This is a couple days ago and it went down that day. So I would have lost money that day. Obviously, price does not just go up forever and it does not go down forever. Think of price as a rubber band. It goes up, it has to bring back itself to an equilibrium or a middle ground, where basically the buyers and the sellers can come together and say, okay, we're good with this price, let's continue. It's basically like a truce. It's like, all right, cool. Whether the buyers win or the sellers win, depending on the trend. But it's basically a rubber band. It comes back and forth. It doesn't move in straight lines. So what is a fair value gap and how does it represent anything in the market? Well, let's break down the simple fair value gap. A fair value gap is, let me make this green. Actually, no, I'll just make it gray because it doesn't need to be up or down. This is universal, obviously. Wouldn't teach you something for one direction. But basically, it is a 3 candlestick pattern. Meaning, you see this fucking dog? Meaning that price in this 3 candlestick pattern has made a gap or an imbalance. What does that mean? Well, price during this period of, let's say, 3 minutes, 15 minutes, right? 3 candles, whether that's a 1 minute, 5 minute, could be the hourly, whatever. 3 candles. During this period, it went, in this example, since this is a bullish fair value gap, since we were going up, this has just skyrocketed up. And what did it do in return? It left a gap. It left a gap in the market. This gap, that is a terrible color. This gap, now that looks red. There we go. Because it was red. This gap represents orders that have potentially not been filled because price moved up way too quickly and left an imbalance. Imbalance is an area where a price can potentially come back and fill orders before continuing higher. Why is this important? Because this is technically a retracement. This is an area where price can retrace into before continuing higher, continuing that bullish trend. Or, completely other example, bearish trend. If, let's say, this was completely upside down and we had this, and then we had another one, and then we had another one, and there was some tiny little wicks, and we created a gap right there. That would be the bearish version of this because price can come back. Price can come back and continue that bearish trend. Why is it a 3-candle pattern? Because it is from the wick of the first one to the wick of the second one, leaving the second, or the wick of the third one, sorry, leaving the second one as the move that created that gap. So in the market, we can see them everywhere. Look, right here. We're on the 1 hour too. One here. There's one right above it. There's one right here. Okay. Let's zoom in real quick. How did we find this? We found just get this line out of here so it doesn't mess you up. From this, we're looking at this candle, and this blue candle here. We have this wick and this wick. The gap in between is what our fair value gap would be. And now you can see the price didn't use this to fill. That's fine. What does that tell us? That tells us that we didn't need to retrace. Price was like, hey, we have a ton of sell volume. We're just going to continue to lower. It's fine. Cool. Whatever. But going back to our example up here, fair value gaps are one way that a retracement can represent a retracement. Yes, fair value. I believe I said that correctly. We're going to get into the charts at the end. I'm going to explain equilibrium real quick as well. What is equilibrium? Well, equilibrium is a point from a low to a high or a high to a low that price can come back and fill equilibrium, which is the equal point from the high and the low, which is 50%, to continue higher. But what does this mean? Because if we waited until it came all the way back up here to realize that it made that low at equilibrium, then we would why didn't we just wait for the break of structure, right? Well, that's where this next piece comes in. When we get a retracement on, let's say, the 5-minute, from the 5-minute, it just looks like this. Shit, it could be even like one candle here, one candle down, and then one candle back up. Right? Let's say this is what we're looking at on the 5-minute. But on the 1-minute, this is where break of structure, like I said in the previous video, comes into retracements. Because on the 1-minute, let's just write this real quick so we remember the 5-minute. Just this and that. On the 1-minute, we might come back, right, from this level. This is this high. From that level, we might come back down, break structure to the downside. You can see this level here, broke structure, came back, filled the equilibrium, and then came back up and broke structure back up. Now, why? Here, let's tighten this up a little bit. Why do we care about this? Well, if we look at equilibrium, what did we have? We hit equilibrium, okay? We also got a break of structure. What is that telling us? Bearish confluences are getting disrespected. Bullish confluences are getting respected. Meaning that this right here, where my mouse is basically this point right here. And remember how we waited for this candle close right here? And we said, well, why don't we just wait for a break of structure? You can absolutely do that. But this way right here, we can get an entry down here. And that's basically our entire move. So now, and obviously we're not talking about strategy, but now you can enter targeting way higher than if you waited until this candle closed, and then you would probably have a terrible risk to reward. That is why we use break of structure in retracements. And also, to get a proper retracement, we're going to want to see a break of structure on a lower time frame. So that's this same example with the 5 minute, the 1 minute works on the hourly, in the 15 minute, hourly in the 30 minute, the 4 hour and the 1 hour. It's all the same. On a lower time frame, a retracement that just looks like this, a 3 candle pattern, could potentially be breaking structure to the downside and then re-breaking back up, which would continue our trend. Now, why do we care about, like, why even wait for a retracement? Like I said, price does not move in straight lines. We're going to want to rebalance. This is where price respects the area. Sellers are like, okay, cool, that's fine. And then we continue higher. Or buyers like, okay, that's fine. And then we continue lower. So now let's get into the charts. All right, we'll leave all this stuff up. Now, let's go. We have the 1 hour here. And you would obviously take this with a liquidity sweep. It would be off of a liquidity sweep or from a liquidity sweep. Let's just say, let's use this for an example. We swept this. Today was not a very good day for a trade. But let's use this as an example. Right here. Mark this out so we can find it. Lower time frame. Let's go down to the 5 minute. Go back in time here. And what do we see? Well, we see this right here, right off the gate. Let's get rid of this. Right off the gate, what do we see? We see a high, break of structure, down, put in a low. What do we want to see between this low? We want to see a retracement. Sorry, retracement, back to equilibrium. Either one really matters. Technically, it would be this low because we don't actually, is that a green candle? Oh, yeah, I'm tripping. All right. So we have equilibrium from the high down to the low. You can see we filled equilibrium before continuing lower. What did we also do? Oh, wait. Wonderful. For those in the back that said it. We filled a fair value gap. We filled the fair value gap. Wonderful. What did we probably also do? Let's go to the 1 minute. Where is it? Oh my God. There it is. All right, we had this level from here to there, just so you guys know. That was the equilibrium, right? We filled it, remember? Filled equilibrium before continuing lower. Guess what we also did? Let's get rid of all this. We came down, move up, then move down. We're in a bearish trend. Then what do? We broke structure up, all the way up. We're still in an uptrend. And then what did we do? Put a low in, and then broke the structure. See this candle right here? We broke, or this one right here. We broke the structure, right? Zoom in here, draw a line. See this low? That's what we were looking at. This is a doji candle. We weren't really looking at that because that's not an up or a down. We're looking at this one. Even if we were looking at that one, still a break of structure. This one's a little safer. Broke structure, bam, that would be our entry right there. All the way down to the bottom of the ocean is our take profit with Dory and Nemo. So, as you can see, that is a easy retracement method, and I didn't even script where on the chart we were. Let's do another one. because some people are going to be like, oh, well, you knew that it was going to do that. I did. Let's do another one. Let's do it on the hourly. All right. And we'll use the 15-minute for the break structure. Random one. All right, let's see. It was so choppy in March, so that's kind of a bad example, but let's see. See what we can find. Perfect. See this? Move up, then move down. What do we got? Equilibrium. See it? Before we continue lower. What do we also do? Fill the fair value gap. Where? Right here. Right? Let's go down to the 15-minute. Find that area. $15-minute. Bam. What do we do? Break structure. What do we also do? Bam. Broke structure again. Would we enter off a break of structure if we got a fair value gap? No, probably not. But to see a proper retracement, that is a solid confluence that, hey, this is a solid retracement. You can even go a step further. Go down to the 5-minute. Really get a break structure. Because if you think about it, a 5-minute down to a 1-minute is a pretty significant change. So go down to here. Roughly the same kind of thing. You would be about down here. But when you respect a fair value gap, the best way to know that you respect a fair value gap is think about it. All right, you have a move down, a move up, and then a push down, a green candle or a red candle. In this situation, since it's a downtrend, you'd want a red candle. In an uptrend, you would want a green candle. You have the confluence that, hey, we came into this gap and now we're going to start pushing lower. And you want that candle to close, just like this one did right here. You can see we came up into it, we closed red. Cool. That's our entry. Bam. That's our entry. Go back to the 1 hour. Let's show this again. Because this is very, very simple. It happened right here, and we even came back into the gap and pushed it lower, but we don't really care about that because that was another retracement. Technically, that is when we hit equilibrium for real, because equilibrium wants a close above, just like we just did with this example where you'd want a down candle or an up candle depending on the trend. It's the same thing with equilibrium. You'd want a confluence. Hey, we're probably going to continue lower, or we're probably going to continue higher. That is done through a close of a candle in the opposite direction, or in the direction that you want to go. So if we just had a green candle like we did here, we'd want a red candle, or in my case, black candle going down. That shows, hey, we're going to push lower. We're respecting this equilibrium. That is what we're going to be looking for in that situation. Let's find another example. Let's find some more. And this is something you can do on the chart. It's like, this is technically backtesting confluences. It's not backtesting a strategy. It's backtesting confluences. Right here. See, they happen all the time. Move up, then move down. Right there, equilibrium. We also came in, filled this fair value gap right here, and bam. And you might say, well, hold on. We inversed this fair value gap. Don't get ahead of yourself. We didn't talk about inversing fair value gaps yet. Why? Because it's another confluence. We are going to get into that. Why this doesn't matter in the next video. The next video is what is an inverse fair value gap. That one's going to explain how you use inverse fair value gaps with all of this, with retracements, with break of structures, with equilibriums, everything. But for right now, we're talking about retracements. So here we go. Here's another one. You can see low up to this high, equilibrium, also in a fair value gap right here, and bam, continue higher. One thing I do want to point out about a fair value gap that sometimes can be a little tricky, and you're like, hold on, fair value gaps, it's kind of like iffy, right? Let's look at this example right here. Let's get rid of these. And let's look right here. Do you see this fair value gap right here? See that? Yes. Okay. You also see this one. Okay. We're going to use that one because is the lower one, the top one got inversed. We're going to get into why we don't give a fuck that it inversed that one in the next video. But for now, let's just use this one. Now, we made a move up right here. We made a move up, and then we made a little bit more of a move up, then came back down. And you might say, oh, well, we respected this fair value gap, and we're going to continue soaring to the moon. But why didn't we go all the way up? Why did we almost go into a little downtrend? Well, because that fair value gap doesn't really mean anything anymore. Why? Because we pushed above this high. Do you see this high right here? The one that this arrow is pointing to. Once price goes above that, it's basically telling the market, hey, we have enough volume and pressure to go higher that we do not need to fill that fair value gap. We don't need to fill those orders. We're going to just leave it. And that's fine. The market does that. The market does whatever the fuck it wants. That is when you don't want to look at fair value gaps. As soon as we put in a high and then a high, which is a move up and a move down. So we have that little move down. As soon as you see it even wick above there, you don't care about that fair value gap anymore. Even if there's a huge fair value gap right here, you would not care about it because we already went above there. And odds are we're going to inverse and shabam. Now, obviously, nothing is 100% guaranteed. Trading is very probability based, meaning that even though we don't care about this fair value gap, technically it did hold. But there is plenty of examples that they don't hold. For example, this one. Actually, sorry, that's not a fair value gap. I'm tripping. Hold on. Ready? We're looking. All right, if we come across another, I'm not going to specifically look for that. Let's just go over some more retracement examples, because that is what we're talking about. This is 22 minutes now. I think we covered a lot, but I gave you guys a couple more retracement examples because it's very important. This right here, retracement. What do we do? High, low, equilibrium, filled the gap, bam, down. Even right here. What do you think happened here? What would you do in this situation? We technically retraced. And you might say, well, we didn't even touch equilibrium, not even close to it. Okay, but let's look a little closer. I'll give you a second. What else did we do? We respected this fair value gap. Right there. As tiny as that thing is, that's all price needed to push lower. And how do we identify that that is a solid move? One, we could have just waited for this 5 minute that closed below it. Or two, we could potentially have gotten a break up and a break down, which we did. Broke structure up right here, and then we broke down. It honestly was like the same entry, a little bit sooner, but that is the same thing. We respected that fair value gap. Let's go back to the 5 minute. Find another example. Right here. It's just spawned in. Move up, then move down, and move up. Makes the low, draw the equilibrium, and bam. Fair value gap, and we hit equilibrium. Bam. Move down. It is that simple. That's all you need. And like we just did that one example, you don't need both. You just need one. So this one, we didn't even have a we didn't have a fair value gap. You can see that this wick and that wick, fine, there's no gap. But we still hit equilibrium and continued higher. So do this in your chart. Go back and back test this and just go back and just draw them out. It's good to identify them because then it's like aimbot. You know, you can see them. Here's that example again. Look at that. We found it. But yeah, that's this video. This video is all about the simplest retracement breakdown video you're possibly ever going to watch. Next video, we're going to be talking about inverse fair value gaps. Why do we care about them? What do they do? How do we use them in confluence with retracements, with liquidity sweeps, with everything else that we went over in this series so far? And we got some more things to cover. So stay tuned. See you in the next one.